Hey gang, welcome to Time in the Market, the investing channel with a long-term focus, taking a look at Salesforce, ticker CRM. They are in the customer relationship management business, basically software that helps customers, mostly enterprise customers, manage their relationships with any of the customers that they may have. So it's like, Salesforce is focused on sales, Tableau is focused on data analytics, Slack on messaging within the company or outside the company. So a lot of software solutions that they may have focused on a variety of tasks. They got Einstein Copilot for their AI stuff. Again, everybody has AI stuff, and they tout themselves now as the number one AI-focused CRM company. They are the number one player in the CRM business, but this is a competitive space. You've got HubSpot, SAP, other players, even Microsoft, even Oracle doing a bunch of stuff. There's been some rumors that somebody might acquire HubSpot. Who knows? Certainly Microsoft is moving into a lot of this automation, software automation. You can kind of see their Copilot, Microsoft Copilot announcement where you could just it watches what you do on the screen and it starts doing that for you automatically if you let it. So companies are probably looking at stuff like that and saying, well, we have all of this CRM stuff from Salesforce that we're paying a lot of money for. 5 to 10 years from now, are we going to be able to do that more in-house with kind of, Microsoft solutions or other solutions that may exist? There's a ton of companies pouring a ton of money into generative AI, and they're not doing that to sell $9.99 a month services to people like me. They're doing that because they feel like they can make a ton of money with enterprise solutions that are probably going to compete directly with a company like Salesforce. And on top of that, the enterprise market is starting to cut back on costs a little bit. So you're seeing some of the growth that has driven Salesforce multiple expansion come down a little bit. And that's obvious in the results. So that's why they're down about 20%. So the earnings themselves weren't terrible, but I think there's always going to be worries that this is a sign of things to come. And there's also the fact that they have been growing at 20% plus for years and years and years. And now they're starting to come into the high single digit range. And that kind of necessitates a reevaluation of the multiple. This company has been in that 2 to 3% free cash flow yield for a while, maybe in the 3% range, more so than the 2% range. And now it's being repriced. It was repriced kind of towards the latter part of 23, I want to say 23, 22 rather, early part of 23. And this was when I was a buyer of CRM. I did own this stock in the past. Bought it in the 150 range when it was trading at something close to a 6% free cash flow yield. And for a decent company like Salesforce, that was pretty interesting. And then it ran all the way up, even though kind of growth was slowing. It was kind of obvious by March that growth was slowing. Probably should have bought puts, but hindsight is 2020. And now it's kind of back down into 200s as that growth is actually real. So as we look at their growth history, 25% growth basically every year until their fiscal year 23. Now it's kind of down into the high single digits for the estimates. That's worse than 25%, obviously. On the opposite end, they've had margin expansion since then. Went from 20% free cash flow margins in 17, kind of heading towards 30% free cash flow margins in 2024 fiscal. So that's pretty good. Obviously, the bottom line is improving at a much faster clip than the revenue is growing now. Because of that, they had some layoffs in 23, some more layoffs in 24. All of that flows down to the bottom line. But it also speaks to what other companies are doing. They're cutting back on costs, and they're probably not signing as long-term deals with companies like Salesforce. They're less likely to move CRM services. They're less likely to add services from a company like Salesforce if they already have them. So that's leading to slowing growth. And that growth isn't slowing all that much more than what they guided. Revenue was 11% for Q1 25. This is fiscal year 25. Again, that's only a 0.2% miss against their guide. What's a bigger miss is they kind of had a 10% hit on current remaining performance obligations, kind of the contracts that they have in the future. That was a 10% growth against 11% growth. And again, 11% growth guided. So if you feel like, well, 1% growth doesn't feel like such a big deal, and it's really not. But if you compound that against 5 years, if you look at, well, they're going to miss by 1% in 25, what does that mean for 29 or 30? It's probably a $2 billion miss. Pretty big, right? That's pretty big if you compound that. And if that continues to be the case in the future, where maybe they'll miss again in Q2, they had to change their guidance. They lowered their kind of reiterated their annual guidance, but again, that's still a miss against what the market expected by about 0.4%. They lowered their EBIT guide, even though they increased their non-GAAP EPS, which is, again, kind of driven by stock-based compensation. You kind of see their GAAP operating margin, 18.7%, their non-GAAP operating margin, 32.1%. Big gap, forgive the use of the word gap, there against the two, and that's driven by a bunch of stock-based compensation that they have. So again, lowering a bunch of guidance, lowering their annual subscription revenue guide driven by this performance obligation, driven by this subscription support revenue. So you look at their earnings and you say, well, they're only lowering this stuff by 1 to 2% at most. What's the big deal? Why is it down 20%? Well, it's because the market's looking at this differently after this earnings, because with a lot of these companies, you saw it with Mongo Database, you're seeing with Salesforce, they're basically priced for perfection. And if you miss by even 1%, the assumption is the growth that we're pricing into the stock isn't there anymore. And I think the issue right now is with a lot of these companies that have thrown the word AI into the mix, the market looked at it and say, wow, AI-focused CRM, we better price it up because they're going to make a ton of money off of AI. That's maybe true in 3 to 5 years, but right now, nobody is really making any money off of AI except the infrastructure people. So, maybe NVDA, which I own, is making a ton of money because they're selling all of the AI chips to other companies that are trying to make generative AI work. And that's great because generative AI seems interesting, but none of those companies are making that much money or any money out of that stuff. And maybe cloud companies are making some money because all of the AI stuff is being stored on their platforms. But other than that, these guys probably certainly aren't making that much money off of generative AI because it's not showing up in their results yet. Will it in the future? Potentially, but it's certainly not right now. The question is going to be, and it's always going to be, Google, Amazon, Microsoft, OpenAI, Anthropic, etc. They're pouring a ton of money into, maybe not Amazon, but all of those other companies are putting a ton of money into generative AI efforts. They're not doing that for fun. They're doing that because they think that these AI efforts are eventually going to lead to some sort of revenue boost, profit boost. And I think what they have in mind is they're going to have offerings that are going to be attractive to enterprise consumers, which are the companies that are going to make you money. They're not doing it because they can sell me a $3.99 a month service to use generative AI to write fiction stories. They're doing it because they can make millions and millions and millions of dollars with contracts with enterprise and government entities that are going to directly compete with offerings like Salesforce, with offerings from other CRM companies. Because if you look at some of the stuff Microsoft has already shown, if you look at some of the stuff OpenAI has already shown, like Microsoft Copilot basically looks at your screen, figures out what you're doing, and kind of automates some of the mundane tasks for you. Some of that stuff is already being done by Salesforce with their Einstein Copilot program. And maybe it's easy for them to just say, well, why would you switch to Microsoft when you could stay with us and have all of these other stuff and we also have a Copilot product? Maybe that's the case because moving CRM platforms is very difficult and a lot of these companies do depend on a lot of the services they offer. But if Microsoft or other companies could offer something similar at a much cheaper price, going to lead to a much more competitive environment for a company like Salesforce, and there's going to be a lot more competitors entering this space in the future. I don't think it's a short-term problem for them, but in the long term, that's certainly something that I'd be worried about as an investor, kind of looking at the guidance here. A couple of important things. Again, slowing growth, 8 to 9%, slowing growth in Q2, driving lower growth in full year 2025. Operating margins, still pretty solid. Big difference, again, between GAAP and non-GAAP. Big difference between GAAP and non-GAAP EPS. I feel like GAAP is more relevant than non-GAAP because of the amount of dilutive stock-based compensation they have, although they do buy back a good amount of shares in the last 12 months, so probably not that dilutive to investors. And then you've got operating cash flow growth at a pretty good clip, like we talked about, layoffs, cost cutting, et cetera, and you can kind of see where their money's coming from, what's growing. MuleSoft growing at a good clip, Tableau growing at a good clip, Slack growing at a good clip. So that's kind of the thing you look at when you look at their growth in the last couple of years. It's acquisitions. They acquired Slack in 2020. They acquired Tableau in 2019, MuleSoft in 2018. They are sitting on a very good balance sheet. If you look at their financials, you look at almost $10 billion in cash, $7 billion in short-term investments against about $8 billion in debt and $3 billion in capital leases. They have the capacity to acquire something, and I think that's going to be what they're going to do in the next 12 to 24 months. They kind of said we're kind of cutting back on acquisitions, but now that growth is slowing, are they going to be forced to do something here to spur growth again? And I think the answer is going to be probably, as we look at the valuation here, disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence and all of that good stuff. A couple of things when we look at the valuation, 211 billion market cap, really good balance sheet, so no actual debt issues, so an EV that's slightly below that, sitting on 4.4% in free cash flow yield based on the last 12 months, probably closer to 5% on the next 12-month basis, 5.5%. Decent valuation here. That's kind of bringing it to a spot where it was around the spot it was when I bought it a couple of years ago. It's trading close to 6%. At that time, their margins were lower, but they were growing faster. Now they're growing slower, but the margins are higher. The question is going to be, are they going to be able to keep margins as high as they are in 24 or expected to be in 25 fiscal year? Or is some of that competition I'm talking about going to force their pricing to come down, going to force their hand? Are they going to be able to restart growth again? If you look at what the estimates are kind of expecting, what the market's expecting is, there's going to be a slowdown in growth in 25, and this isn't even baking in the 8 to 9% here. This is maybe closer to the 9%. I'm a bit more pessimistic maybe. And it's going to kind of go up in the next couple of years. Another thing is they were kind of diluting shareholders up until 2023 with stock-based compensation, issuances of shares due to acquisitions or just whatever. That stopped last year when they started to initiate a bigger stock buyback, but that buyback still isn't huge. Yeah, they bought back 7 billion in shares in the last 12 months, as you can see here, 7.6 billion, but they also issued about 2 billion and they had about 3 billion in stock-based compensation. So some of that kind of probably overlaps the stock-based compensation in the issuing of shares. But at the end of the day, you have to kind of mute the fact that they're not really buying back all 7 billion of those shares. Some of that is diluted by the issuances of shares and the stock-based compensation. And then secondly, from a capital allocation perspective, they started to issue a dividend, 40 cents to start in the last 12 months. Again, that's going to make it show up in some dividend ETFs, might be a good thing for valuation, etc. And I'm expecting that to grow at about 10% in the next couple of years. So as I look at my valuation, you can also look at your valuation here. If you want to use the spreadsheet, hit file, make a copy. I'll link it down below. I'm kind of being more pessimistic about growth. Seeing that the year, maybe as the year progresses, they're going to have to reissue guidance down a little bit, 7.5% growth, 30% margins still on the free cash flow side. And then as the years progress, I'm not expecting them to really get back to growth again. I think there's going to be issues with competition, maybe some acquisitions that others make to get into the CRM space. HubSpot is a prime candidate for that. I think they're valued pretty richly, probably because of that. And then as margins expand, I don't expect them to expand as much as the estimates here do. They have basically 34% margins by the end of the period. I'm at 30.8, so 300 basis points lower. Again, I think AI is going to be a great thing, but it's TBD as to who's going to make the most use out of it, how that's going to impact a company like Salesforce. Again, I don't think Salesforce is going anywhere. I think they're so entrenched in the enterprise CRM space that they're here for a while. It's just, can they sell more services to companies that they already have? Are companies going to be less likely to move in the next couple of years because they're entrenched with other companies, because there's other competitors offering better pricing, better services, whatever? And are companies just kind of cutting back on costs in the next couple of years? There's already a bunch of layoffs across the entire enterprise space, including Salesforce. Does that mean they need less and less services? Because some of their services are probably on a per use basis, not just a contract basis. So some of that stuff is going to impact their ability to generate revenue and or increase their margins too much. So as I look at the valuation here, a company like this with slowing growth, with still decent growth and somewhat expanding margins, I think that it's somewhere in the 5 to 4% range. I'm just putting everything in the 5% free cash flow yield. You can kind of say, well, if they're going to start slowing even faster than the market expects, why shouldn't they be in the 6% free cash flow yield? Because this is still a marquee company. If you feel that way, that's certainly a less attractive certainly a less attractive investment at a 6% free cash flow yield if the market prices it that way, but I don't think it's going to get that bad. Right now, it's pricing it in the 4.5% free cash flow yield based on the last 12 months, about 5.5% based on the next 12 months. So it's kind of in the middle of that 5% free cash flow yield that I'm giving it. And at today's price point, and with the buyback yield, I'm assuming about 10% of their free cash flow goes towards buyback. And again, that's 10% total offsetting the stock-based compensation that they're going to issue. So if you kind of look at, they bought back about $2 to $3 billion worth of shares in the last 12 months. Maybe I'm being a bit conservative with 6 to 7 billion in the next 5 years, but maybe they'll still issue more shares to make an acquisition, or they'll issue more shares, stock-based compensation based on the fact that their stock is lower now to retain talent, etc. So that's something to keep in mind. But you can play around with these numbers as you see fit. So adjusting for buyback yield gets you about a 7.9% return based on these assumptions, plus the dividend yield gets you about a 8.7% weighted expected return here. With my target return of 10% means that I'd need a fair value closer to 198 to be a buyer. And I feel like that's a relatively reasonable price, but I also feel like at 218, this is a relatively interesting investment. So if you're buying at 218, it doesn't seem crazy to me. You're getting it at a valuation that's not that much off the highest it's ever been on a next 12-month basis. You can kind of see that if you go back to the history of this company all the way back to 2011, it's only been at this rate for 2 short-term stints. Kind of where I was buying it in the 150s. Now that their margins have expanded, the free cash flow is a lot higher. Even though the price is at 200, it's sort of in that high 5 range, mid to high 5 range. So if it drops a little bit more, I'd be very interested. As it stands right now, I'm kind of interested. I'm kind of thinking about maybe doing some leaps or even some short-term options, just a little bit, just to see if there's a bounce back. A lot of times these companies that react really heavily to an earnings call that wasn't that bad bounce back relatively quickly. So if there's a short-term bounce back, I can certainly play it that way. But usually I'm more of a longer term investor. And for a company like a CRM, because of the worries I have about what AI might mean for a company like this, that probably isn't spending as much money on AI solutions as other companies that have a ton more CapEx. You think about Google, you think about Microsoft, you even think about Apple. Can those guys do more than a company like Salesforce can with AI? And I think the answer is yes. And how is that going to affect their business? And my worry is that it's going to be negative, so I'd need a bit more of a risk protection here to get to an interesting price point. At 197, I'd be interested. I always look at a 15% target return. At 158, I'd be very, very interested, because I think this is a company that's going to stick around, raise their dividend. Maybe growth is going to slow. If they can make an acquisition that's interesting, that kind of gets growth spurring on again, this could really fly back into that 3 to 4% free cash flow yield. And then you're looking at a 13 to 19% annual return. It's pretty interesting to me. So that's Salesforce. That's my price point. I think I'll set a trigger just slightly under 200. Maybe play with some short-term, long-term calls in terms of getting a bounce back. But I'm generally more risk averse than that. Let me know what you think about Salesforce if you're interested. Again, I don't think their products are great. I use Tableau. I use Salesforce in my day-to-day. Not fantastic, but they do what you need them to do. And in a lot of ways, that's all you need from a CRM solution. And they're the number one player because of that. And it's hard to move away. Like if you're a Salesforce company and you're a big company and you want to move somewhere else, it's going to be expensive to retrain your entire staff on all of these products. They're kind of complicated. They're kind of a pain to use. And maybe that's why all of these companies make their products a pain to use, because, hey, you're stuck with us because all of these other ones are a pain to use as well. So if you move, it's going to be a pain for you to retrain everybody, and it's going to lead to lost sales. So you don't want to do that. So that's my thought about Salesforce. Let me know what you think. Am I off on anything over here? Do you disagree with me? Do you agree with me? Leave a like down below. Leave a comment down below. Subscribe, all of that good stuff. Thanks for watching. Bye.